Welcome to the DJM Finance Podcast, and today I wanted to share what I've seen as the real asset split of financially independent Canadians.
DJ Finance.
What's going on, everybody? My name's Kamal, aka Swiss the DJ, aka Mr. Morrison, and this show is all about me documenting my journey on the road to financial freedom. Today, I wanted to talk about something that doesn't get discussed about when it comes to financial independence, especially here in Ontario. And that's this: how much of your net worth should be tied to your home versus your investments? In Canada, we've been conditioned to believe your house is your investment. But is it really helping you become more financially independent, or is it slowing you down? Let's break it down. Well, first, there's the mindset problem. If you live in the Greater Toronto area, you know how it goes. You talk to a mortgage broker or you go to a bank, you get approved for a certain amount, and most, but not all, buy right up to the limit that they got approved for. The most common sayings when buying real estate is, real estate always goes up. It's a good investment. But here's the reality that no one tells you. Your primary residence does not produce income. It does not pay you monthly. It does not fund your retirement. Unless you sell or downsize, it's just equity sitting there. When you maximize the amount of debt to purchase a home, can you really afford it? Are you breaking the 20-30-3 rule to purchase a home to avoid being house poor? The rule states that you should have a 20% down payment, only have 30% of your monthly income go towards housing, and the purchase price of the home should be no more than 3 times your household income. If you break those rules, you're going to have a heavy mortgage payment and less money at the end of the month to invest. What are the financially independent people doing? When you look at the people in Ontario who are pursuing or have achieved financial independence, they have a different asset allocation. A typical breakdown can look like 50 to 70% in investments. So this is ETFs, stocks, rental properties that cash flow, or investment in retirement accounts in your RRSP or tax-free savings account. 20 to 40% in their primary residence, and 5 to 10% in cash or liquid reserves. Here's the key difference. They don't overextend on their home. Just because they can afford a $1 million house doesn't mean they're buying it. They might choose a smaller home, a townhouse instead of a detached, or even continue renting. Why? Because they understand one simple principle. Cash flow builds freedom, not equity alone. It's funny because the other day I was at the gym and I was talking to this guy who's done extremely well for himself and who is financially free. And he pretty much got there by purchasing real estate that cash flows. The trap of the big house. Now, this was important to me as me and my wife purchased a home last year. We didn't want to max out what we could borrow, have a large mortgage, and have minimal investments. We wanted an affordable home, a lower mortgage, and a surplus at the end of the month so we can focus on investing. I don't want to grow older and have more home equity and have a limited investment portfolio because most of my income was going towards my mortgage. I want a strong investment portfolio, passive income building with options, freedom, and flexibility. I believe people chasing the big house today versus the people chasing financial independence is one is optimizing for lifestyle today, while the other is optimized for freedom tomorrow. So let's look at home ownership versus financial independence. According to Stats Canada, in Ontario, about 68% of people own a home. So roughly that's 2 out of 3. There's no official stats on people who are financially independent, but let's look at some wealth numbers. To be in the top 10% of wealth in Canada, you need to have a net worth of $1.5 to $2 million. To be in the top 1%, you need to have a net worth of over $8 million. Most people who have achieved FIRE have about $1 million to $2.5 million invested. Some people in Canada have $1 million of net worth just in their home, but that doesn't mean they're financially independent. So realistically, it might be even less than 10% of people who are financially independent, maybe even closer to 5. So 68% of people own a home, but only 5 to 10% of people are financially independent. Wow. These are some interesting numbers to look at. Some financially independent people in Ontario choose to rent. And it's not that they can't afford to buy the home, it's just that they ran the numbers and decided that it wasn't worth it for them. They look at cost of ownership versus renting, opportunity cost of tying up capital, and flexibility. To go even further on this topic of cost of ownership versus renting, and to get a better understanding for myself, I just purchased a book titled Quit Like a Millionaire from a Toronto couple, Christy and Bryce. They reached financial independence in their early 30s without purchasing a home. I just listened to them on a podcast, and I'm interested to get the details of their story. As I stated before, there are people who've achieved financial independence without purchasing a home. However, this was something that was important for me and my wife. We were both raised in a home, and that's something that we wanted for our future family. So far, so good, as we purchased our home using the 20-30-3 rule. Right now, it's about keeping expenses manageable, growing income, and a heavy focus on investments. The investments will pay for our retirement, give us options, and create real financial freedom. I think if there's anything to take away from this episode, is that your home is part of your net worth, but your investments is what builds your freedom. Building a life where your money is working for you, you're investing consistently, and you're creating options for your future. Because that's what financial independence is all about. If you enjoyed this episode, share it with someone who's thinking about buying a home right now. It might change the way they approach it. As always, I'll catch you in the next one.